In this video, we'll take a look at some various monthly dividend-paying stocks and funds that, as of the making of this video, have never gone through a dividend cut. As I discussed last week, a lot of higher-yielding dividend investments are experiencing stress right now because of higher-for-longer interest rates. Up to this point at least, all of these investments are still going strong and haven't reduced their dividends. Obviously, I can't guarantee they won't ever go through a dividend cut, but it's definitely worth looking into the health of these investments and gauge how they're holding up. I've discussed or just name-dropped all of these in the past, and for some it's been a long time since we've checked in on them. So with that being said, let's get into it. The first holding we'll take a look at is the Guggenheim Strategic Opportunity Fund, ticker GOF. This is a closed-end fund that's had one of the best monthly dividend track records in the market. Since its launch in 2007, GOF has never reduced its dividend. They have been able to grow it just a couple times in its history, although the last time we saw a dividend increase was all the way back in 2013. If we look at its portfolio breakdown, it's going to be pretty surprising that they haven't ever had to cut their dividend. As of June 30th, 39% of what's inside this fund are bank loans, and 33% are high-yield corporate bonds. This fund's investments are even riskier in my opinion than what's inside the majority of the PIMCO closed-end funds. But despite that, again, they've never gone through a dividend cut. Between September and October of last year, this investment fell considerably in share price by about 30%. It's still not clear why this happened, but it slowly recovered in share price. It's down in share price pretty decently over the long term, but just like all of these debt-filled closed-end funds, it's been down quite a bit since interest rates were first being raised. We should see a recovery in net asset value once rates start getting cut. In addition, it's currently trading at a sizable premium, which is a unique metric to closed-end funds. The fact is investors have just been willing to pay more for GOF's dividend consistency, so it's incredibly unlikely that you'll ever get your hands on this fund at a good discount. If we look at the dividend trend for this holding, we can see that it doesn't appear to be using more return of capital than average. In fact, it looks like it was actually using a little more back in 2020 and 2021. These numbers are just estimates, and closed-end funds report their final numbers at the end of the year. Return of capital is also just a tax classification, and it doesn't necessarily mean that the fund's actually returning the capital back to their investors. As I first reported on this fund back in 2022, I noticed that it was questionable for Guggenheim to issue so many new shares of this holding. This gave me the impression that this might be the explanation as to how this fund's been able to consistently pay its steady dividend. An issue that exists for a lot of closed-end funds out there is that it can be pretty difficult at times to get a full picture of what's inside a CEF because they often hold so many non-public companies and pretty complex investments. Regardless though, you can see how well this fund has performed since being launched. Over the course of its 17-year existence, GOF has provided an average annual return of 10.28%, which is pretty decent. So given how complex and how high risk a lot of its holdings are, and the fact that it might occasionally rely on issuing new shares to cover its dividend, there is some degree of risk tolerance that you'll need if you want to hold a closed-end fund like this. As of the making of this video, I don't currently hold this closed-end fund, but the people at Guggenheim seem to really want to keep the dividend at its current level, and it's done its job up to this point. Up next we have PennantPark Floating Rate Capital, ticker PFLT. PennantPark is a business development company that seeks to make secondary direct, debt, equity, and loan investments. They only invest through floating rate loans in private or thinly traded or small market cap public middle market companies. PennantPark also invests in equity securities including preferred stock, common stock, warrants, or options received in connection with debt investments. According to their website, it says they provide funding to companies with a proven management team, competitive market position, strong cash flows, growth potential, and viable exit strategies. It's been well over a year since I've gone in depth on PFLT, and what we've been seeing recently from the BDC sector is falling dividend coverage for a number of these companies this year. Trinity Capital, Horizon Technology Finance, Oaktree Specialty Lending, and a few others have started reporting higher non-accruals and falling NII over the past few quarters. PennantPark, though, has always touted to their investors that capital preservation has always been their number one priority and not growth. So with that in mind, in our current BDC environment, how has this company and their dividend been holding up? The good news is that their non-accruals are well below the BDC average. Earlier this month, they reported 1.5% of their investments were on non-accrual, which is well below the current industry average of 3.8%. But if you've been following this BDC for a long time like I have, you'll know this company operates on very thin margins. Almost every quarter they report having a payout ratio that's very close to 100%, and it's been that way for many years. As a result, they haven't been able to grow their dividends too much throughout their history. But looking at the past few quarters, PFLT's dividend coverage has remained pretty consistent. In their last quarter, they again reported a very close dividend payout, which was about 99%. Again, the good news though is that while other BDCs like Trinity Capital and Oaktree have been seeing collapsing NII, PFLT hasn't seen theirs change a whole lot. Also, this BDC was pretty aggressive in making new investments in the previous quarter. You can see that their investment portfolio jumped in fair value from Q1. So overall, I would consider it to be a higher risk investment, but they're still holding on pretty well. Now let's look at BlackRock Science and Technology Trust, ticker BST. This is a closed-end fund that uses a combination of covered calls to generate income, as well as long-term and short-term capital gains on the investments inside of the fund. As the name would suggest, it holds mostly technology and science companies, which would include Nvidia, Microsoft, and Apple. This fund is going to be turning 10 years old this year, and it has a perfect monthly distribution track record. Originally paying 10 cents a month, today it now pays 25 cents a month, which is some pretty impressive growth for a closed-end fund. It's technically not correct to refer to the payments as dividends, but rather distributions, since the source of the income is in part coming from the selling of the holdings inside of it. In other words, long-term and short-term capital gains. But right now it does offer a yield of over 8%, making this an ideal kind of position for those who love monthly income. As you can guess though, a threat to its performance would be a decline in the tech sector. You can see it fell last month when the Nasdaq had its sell-off, and it didn't fully recover in share price from that. Going back further, you can see this massive hump that took place during interest rate hikes. BST still hasn't recovered from that either, although in terms of share price over the long term, it's still up over 86% since their IPO. Just like we did with GOF, let's now look at the dividend source and see if return of capital is being heavily used here. After looking, there really aren't any noticeable trends going on with this fund. In the last 2 months, it did heavily rely on ROC, but it also went almost 2 years without using any ROC between late 2020 and late 2022. In the last 2 months, the majority of its dividends were made up of ROC, but that's also happened in the past as well. There doesn't appear to be any concerning trends regarding their distributions. Also, I think it's worth mentioning that despite its really good track record in terms of monthly distributions, it's currently trading at a discount, and that's often the case here. So ultimately, BST still appears to be doing pretty well, and I don't see any concerns regarding their distributions. There's also an alternative to BST, which is BSTZ. This one offers a much higher yield and possible better growth prospects. But the trade-off that exists is that its dividend is a lot more variable. It's gone up and down several times throughout its short history, but it just recently had a massive increase, going from 11 cents to 21 cents a month. BST would likely be better for people who need that steadier income. And that's going to conclude our look at some monthly paying investments that have never experienced a dividend cut. Hopefully interest rate cuts will improve their situation in the months ahead. Be sure to do your own research and come to your own conclusion before investing, but with that being said, that's going to conclude today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.